Well, it's a great pleasure to introduce once again John Cochrane, who's the AQR Capital Management Professor of Finance at the University of Chicago's Booth School of Business. John completed an undergraduate in physics from MIT and a PhD in economics from Berkeley. He then went to the University of Chicago, where he has been since. I do notice one stint outside academia in the early 1980s. As a graduate student, John spent a year at the Council of Economic Advisors. That seems to have cured him of any desire to spend further time in Washington. John's work straddles macroeconomics and finance, a very useful combination of skills these days. Everyone, of course, knows of his work with John Campbell. And just to give you the short spiel, Campbell and Cochrane add a slow-moving habit formation to the standard power utility function to obtain a consumption-based model which has some hope, the first one to have some hope of explaining asset pricing data. So most of you know of that. Perhaps fewer of you know of his early work examining how large the random walk in GNP is, or of his recent work on the fiscal theory of the price level. But it's way up there in quality, along with all the work in asset pricing that you do know about. But I'm almost sure that none of you know about the fact that John writes a regular column for Soaring magazine and has published authoritative papers on gliding. My job, however, is to move away from all the great research he has done, and of course John has done a great deal of it, and to tell you a little bit about John Cochrane, the person. Now, for many of us at Chicago, John epitomizes its essence. His willingness to ask the simple but tough question, whether in a seminar or when we are debating the strategic direction of the school, it keeps us from straying. John loves to argue, but the point of the argument is to get closer to the truth, not to score debating points over his opponent. And John is very good at drilling down to the essence of an argument, clearing an argument of all the dross that usually surrounds it. In fact, anyone who's sat in on a course that John has taught, and I've sat in on a couple, can attest to the fact that John's descriptions of other people's models gets to the essence so much more directly than do the originals. In fact, John will say modestly that he is a simple guy who can't understand complicated models, hence he has to simplify them. But I think the truth is that he understands them far better than those who wrote them down. There are so many aspects of John that I could tell you about. We could be here the whole night and we could skip his speech. But I'm sure you're interested in listening to his speech. So I could tell you, for example, about why his kids call him the grumpy economist, as evidenced in his response to Paul Krugman's critique of the economist profession. And I quote here, "Paul Krugman has no interesting ideas whatsoever about what caused our current financial and economic problems, what policies might have prevented it, or what might help us in the future, and he has no contact with people who do." It goes on. Irrationality and advice to spend like a drunken sailor are pretty superficial compared to all the fascinating things economists are writing about these days, end quote. All I can say is that with John, you never are unsure about where you stand. I could also tell you about John, the devoted father who's ready to drop his work at a moment's notice to help his children with homework. I could tell you about John, the kid who learned French by reading Asterix and Tintin in the original, or about the man who complains his Italian colleagues invariably switch to practicing their English as soon as he tries to practice his fluent Italian with them. But I want to end with 3 vignettes from people who know him well. First, from Gene Farmer on his first encounter with John. As Gene puts it, Eddie Lazier and I were resting our broken bodies on the beach after a challenging windsurfing session with 25-knot dead onshore winds and a 5-foot shore break. I think what Gene means is it was really, really tough out there. Gene continues, "Well, John arrived and clearly had the wrong equipment for the conditions. He informed us that he was a windsurfing neophyte and headed for the water. I looked at Eddie, he looked at me, and we both simultaneously blurted, 'I'm not going to save him.' John survived and thereafter quickly became one of Chicago's best windsurfers. John is clearly willing to plunge boldly where others fear to tread, whether in real life or in research. John moved on from windsurfing to gliding. When John was a child, his mother took him and his brother Nick each for a glider ride. Nick landed, sick to his stomach, and has never flown in a glider again. But after John's turn, he said 5 words to his mother: "I want to do that." Now, John never looked back and represented the United States in the World Gliding Championship in Hungary last year. That's something I bet most of you don't know. But the gliding story I want to tell you comes from Jeff Russell, his gliding buddy at Booth. And Jeff says, when John was selling his plane to purchase a new one, his plane was in flawless condition, except for a scratch on the canopy. He agonized over whether or not to pay the money to get it fixed so he could advertise the plane as in flawless condition. But in the end, he decided to sell it as is. The next flight, however, he forgot to lock the canopy prior to takeoff. As he took off, the canopy swung open and broke free of the plane, shattering into a million pieces. He did a great job of returning to the airport in an open cockpit, looking like Jim Carrey in The Pet Detective with his hair blown totally vertical. But there's a silver lining to the story. The plane with a brand new canopy was listed for sale in flawless condition. So John is not just bold, but also scrupulously honest. And that leads me to my last story, this from his wife Beth, Gene Farmer's daughter. John won her over on their first date by cooking dinner for her before they went to the symphony. As Beth puts it, "I remember thinking that no man had ever made a woman dinner in my family." Yet there he was in an apron, cooking a traditionally Italian meal. I didn't even want to bother going to the concert. I just wanted to get straight to the act of marrying him. And that illustrates my last trait, John as the out-of-the-box thinker, testing and proving the proposition that the way to a woman's heart is through her stomach. Ladies and gentlemen, I give you a wonderful researcher, a devoted father, a loving husband, and my great colleague and friend, John Cochrane.
I'm a menus kind of a guy. Thank you so much, Raghu. I really ought to quit while I'm ahead, which is always good advice, but I won't. The title of the talk tonight is Discount Rates, by which I mean equivalently expected returns or risk premium. Prices should equal expected discounted cash flows. That's our theory. In 1970, Gene Fama argued that the expected part, the testing market efficiency, was the framework for organizing asset pricing research. I want to argue that the discounted part better organizes what we do today. So I'll start with the facts, how discount rates vary over time and across assets. I'll go on to theory, why discount rates vary, and I'll try to categorize theories, something like what Fama did with weak, semi-strong, and strong forms of efficiency. And finally, I'll point to some applications. Now, first, an apology. There's lots and lots of other people's ideas in here, and time is very short. So to be fair, I'm going to mention nobody's name, and I'll send you to the written version of the paper. So discount rates vary over time. And to show you how, start with a very simple regression of returns on dividend yields. The one-year regression in the first row here doesn't seem that important. Yeah, the t-statistic's sort of significant, but there's lots of biases. And the 9% R-squared doesn't seem that great. But this regression has huge economic significance. Look, first, the coefficient's huge. 1 percentage point more dividend yield forecasts 4 percentage points more return. Second, the 5.5 percentage point variation in expected returns, that's the second to last column, that's huge. The 6% equity premium was a puzzle. Now expected returns vary by as much as their level. And third, the slope coefficients in the R-squared rise with horizon. So the picture down there plots each year's dividend yield in blue, along with the subsequent 7 years of returns in red. And that picture captures the central fact. High prices relative to dividends have reliably led to many years of poor subsequent returns, and low prices have led to high returns. Now, long horizons aren't just a debating point. They're especially interesting because they tie predictability to volatility, bubbles, and the nature of price movements. So to make that connection, I use the Campbell-Schiller present value identity shown here. And that identity really is just a rewriting of the definition of return. Now, If you run regressions of long-run returns and dividend growth on dividend yields, as in the second equation here, that identity means that the regression coefficients have to add up to 1. Just run both sides of the identity on today's dividend yield. So that tells us if dividend yields vary at all, they've got to forecast long-run returns or long-run dividend growth or a rational bubble of ever higher prices. So the empirical question is, which one is it? And here's a table of regression coefficients. So you can see the long-run return coefficients are all a little bigger than 1. The dividend growth forecasts are small, and positive numbers mean they go the wrong way. High prices mean low future dividend growth. The 15-year dividend yield forecast, that coefficient is essentially 0. So these regressions are telling us that all variation in price-dividend ratios, all of that volatility, corresponds to variations in expected returns. None of it corresponds to variation in expected dividend growth, and none to rational bubbles or prices that are ever higher. Now that is the true meaning of return forecastability. That's the real measure of how big the point estimates are. Return forecastability is just enough to account for the astounding volatility of prices. In the 1970s, we might have guessed exactly the opposite pattern. High prices reflect and therefore forecast higher cash flows. Our view of the facts changed 100%. The table also reminds us the point of this whole project is to understand the prices, to understand the right-hand variables of the regression, and that how you look at things matters a lot. The long and short-run regressions are mathematically equivalent, yet one transformation shows you an unexpected and very big economic significance. Well, that's just the start. This pattern of predictability is pervasive across markets. Stocks, bonds, credit spreads, foreign exchange, sovereign debt, and houses. The yield or valuation ratio translates 1-for-1 to expected returns and doesn't forecast the cash flow or price change that we might have expected. Houses are so much in the news these days, I thought I'd show you a plot and a regression. The picture is house prices and rents. High prices relative to rents mean low returns, not subsequent higher rents or prices that rise forever. And on the bottom, the house price regressions are almost the same as the stock market regressions. Furthermore, there's a strong common component and a strong business cycle association in all these forecasts. Low prices, high expected returns, high discount rates hold in bad times when consumption, output, and investment are low, unemployment's high, businesses are failing, and vice versa. Now, these facts bring a good deal of structure to the argument over bubbles and excess volatility. High valuations are equivalent to low expected returns and are associated with good economic conditions. So a bubble, all that can possibly mean is that the discount rate is too low relative to some theory. Good. Now we can have a productive discussion. And this empirical project has only begun. We have a bunch of univariate regressions. We need to understand the multivariate regressions. Here are the questions. Which of the many return forecasters are really important in a multiple regression context? In particular, do the variables that forecast one return also forecast another one? Second, what's the factor structure of time-varying expected returns? I said it slowly because it's a big, important word. The right-hand sides here are correlated across the assets, so surely there's one common factor, but how many more do we really need? Third, of course, we need to relate time-varying expected returns to covariances with pricing factors. Expected bond returns correspond to covariances with a single level factor, so what similar patterns hold across all these asset classes? Fun, yes, but there's a challenge. There's way too many right-hand variables. We can't just go run big multiple regressions, but these are the important questions we have to ask. And last, of course, how does the multivariate perspective change our perspective of prices and long-run returns? So I looked at Letow and Livingston's consumption to wealth ratio as an example to explore this question. In both cases, the green lines are return forecasts from dividend yields, and the blue lines are return forecasts that use both dividend yields and the consumption wealth ratio. So in the left panel, you can see how the consumption wealth ratio helps a lot to forecast the red line, which are ex post one-year returns. But now look at the right panel. These are long-run return forecasts. The green and blue lines here are almost exactly the same. Adding the CAY variable has almost no effect on long-run return forecasts. It just alters the term structure of expected returns. And here the red dashed line, that's actual dividend yields. And you can see dividend yields variation, it still corresponds almost entirely to discount rate variation. Now, is this pattern true in general? I don't know. Actually, I suspect not, and I was hoping not when I made the graph. The point is only that multivariate long-run forecasts and pricing implications can be really different from one period return forecasts, and that we should look. Let's look at the cross-section. In the beginning, there was chaos. Then came the capital asset pricing model. Every clever strategy to give high average returns delivered high market beta as well. And then the anomalies erupted, and there was chaos again. Here's a picture of the value effect. I used the Fama French book-to-market sorted portfolios. Average excess returns, those are in blue, they rise as you go from growth to value. Now that's not a puzzle by itself, because it wouldn't be a puzzle if the betas also rose. All puzzles are joint puzzles of average returns and betas. But the betas, they're shown in black here, they're about the same for all portfolios. Well, Fama and French brought order to the world once again with the size and value factors. High average returns do line up well with larger values of the HML regression coefficient. That's shown in solid red. Now let's think about what this does. This factor model accomplishes a very useful data reduction. Theories now only have to explain the HML portfolio premium. They don't have to explain all the individual assets. And that covariance is a central result. If all the value firms decline, they decline together. But that's another challenge. Theories have to explain this common movement. It's not enough just to generate individual price fluctuations that mean revert. You need all those low price securities to move together subsequently. That's harder. Finally, Fama and French found that other sorting variables, like firm sales growth, my favorite, didn't each require a new factor. The three-factor model then took over for routine risk adjustment in empirical work. Alas, once again, the world is descending into chaos. Expected return strategies have emerged that don't correspond to these existing betas. They include, among many others, momentum, accruals, equity issues, accounting-related shorts, beta arbitrage, credit risk, bond and equity market timing strategies, foreign exchange, carry trade, put option writing, and various forms of liquidity provision. We're going to have to do it all over again, but this time with many more dimensions. Now, how do we approach such a huge multidimensional problem? First, we have to ask, which of these characteristics really provides independent information about average returns? We can't just do them one at a time. Second, does each new anomaly also correspond to a factor formed on the same anomaly? Momentum returns correspond to a momentum factor, whatever it means. Do accruals return strategies also correspond to a new factor? Third, how many of these new covariance factors are really important? Can we, again, account for the n dimensions of expected returns with k less than n, I hope so, factors? Now, to approach that highly multidimensional problem, I think we're going to have to address the same questions with different methods. Portfolio sorts are really the same thing as a non-parametric cross-sectional regression. The picture says it all. Having said that, and thought of it as a regression, you can see that a time series and a cross-section are really exactly the same thing. All we're ever really doing is understanding a big panel data forecasting regression, as I showed next. Now, for one variable, either approach works, but we can't chop portfolios 27 ways. So I'm guessing we'll end up running big multivariate regressions. And in so doing, we will unite what seemed like apparently separate time series and cross-sectional forecast and portfolio spread approaches. Portfolio means are still a wonderful way to see the economic importance of forecasts that didn't look so big, but we don't have to estimate things that way anymore. So what we're going to end up doing, I think, is describing expected returns as functions of all these characteristics, and then we have to see if the expected return function lines up with covariances with factors, but those are also functions of characteristics. Sorted portfolio betas are just a non-parametric estimate of the covariance function, and we can estimate that parametrically too. That's a big challenge, but then we still have another step. What is the source of price variation? When did our field stop being asset pricing and become asset expected returning. Why are betas exogenous? What sense does it make to explain expected returns by the covariance of expected return shocks with market expected return shocks? Market-to-book ratio should be the left-hand variable, the thing we're trying to explain, not a sorting characteristic for expected returns. Well, that's a big agenda. Here's a start. One start is to forecast long horizon returns from price decompositions for individual assets and really just functions of characteristics the same way I did in the time series. I also think that a long-run price and payoff perspective might end up being simpler. So as a suggestion, I solved here the Campbell-Shiller identity. I solved it for long-run returns on the left-hand side. And look at that. Long-run return uncertainty all comes from cash flow uncertainty. Long-run betas are all cash flow betas. The long run looks exactly like a simple one-period model with a liquidating dividend. Discount rate dynamics all disappeared from pricing in this long-run approximation. Well, this is all a lot of speculation. I said there's a long way to go, and I mean it. Let's turn to theory. Why discount rates vary so much? So I put together this categorization of theories to serve as a conceptual benchmark, like Fama's weak and semi-strong and strong forms of efficiency. But rather than run through this list tonight and threaten to put everyone asleep, I think I'll just think about how some of these theories might handle some of the recent big events. So I'm old-fashioned. I still think the microfinance approach is promising. This graph presents the market price dividend ratio in blue. You can see the tech boom as the big up and the recent unpleasantness over on the right-hand side. I also present aggregate consumption relative to a habit in red. Now the habit is basically just a long moving average of consumption. So in terms of data, the red line is just detrended consumption. Now, as you can see, consumption and stock market prices did both collapse at the same time in 2008, and high average return securities collapsed even more than others, so some basic consumption beta logic isn't drastically wrong. More deeply, the habit model captures this idea that people become more risk in recessions. As consumption goes down towards habit, they become more risk averse. In the model, the price-dividend ratio moves exactly 1-for-1 with the surplus consumption ratio. So that fit isn't perfect, but the general pattern is remarkably good, especially how many calls I get from reporters asking about the fact that the crisis invalidates all of traditional finance. And lots of similar ideas, like household leverage and outside risks, tell a similar story. Over on the investment side, the Q theory of investment is the natural analog. It predicts that investment should be low when valuations are low, and investment should be high when valuations are high. So this picture contrasts the investment to capital ratio in red, the market to book ratio in green, and the price dividend ratio in blue. Now the Q theory here also connects asset prices and investment probably better than you thought. Recent in the tech boom, where both boomed, and in the recent crash, where both investment and prices corrected. Now, I'm not arguing that consumption or investment caused the boom or the crash. These are first-order conditions, and they're perfectly consistent with the view, for example, that there was a run in the shadow banking system, and that was at least an important amplification mechanism. But surely they're linked better. The risk premia are linked to macroeconomics better through this viewpoint than you might have thought. Well, we see here a pervasive coordinated rise in the premium for systematic risk. It's common across asset classes, and it's present in completely unintermediated and unsegmented markets. Here are government and corporate rates on the left, and the BAA spread along with stock prices on the right. You can see this huge credit spread open up and fade away along with the dip in stock prices. And all of us can access these assets on the Vanguard website. And of course, discount rates are strongly correlated with macroeconomic risk. Is it just a coincidence that people get unduly pessimistic when the economy's in a tailspin? They could lose their jobs, houses, or businesses if systematic risks get worse. Now, one of the nicest and cleanest pieces of evidence for segmented and institutional theories is arbitrage relationships that were violated in the financial crisis. Unwinding these opportunities required people to borrow dollars, which intermediary arbitrageurs couldn't do. And here's a nice example. The CDS plus Treasury should equal a corporate bond, and they usually do. Not so in the financial crisis. The blue and red lines go away from each other. Here's another example, covered interest parity. Investing in the US versus investing in Europe and returning the money with forward rates, that should yield the same rate. Not in the financial crisis. Now these arbitrages are dramatic events. But notice in each case, the difference between the two ways of getting the same cash flow is dwarfed by the overall change in prices. And although these arbitrages are very attractive if you could leverage, they're not big enough to attract long-only or deep-pocket money. None of us changed our checking accounts to covered interest strategies. The price of coffee displays arbitrage opportunities across locations at these meetings. People are still buying it upstairs at Starbucks while the AFA gives it out for free downstairs. There's an interesting combination of transactions costs, short sales constraints, biases, funding limits, and other frictions, but we don't dream this matters for worldwide coffee prices. So maybe it's possible that a macro view still builds the benchmark story for overall big movements, with very interesting spreads opening up in some markets due to frictions. I don't mean to make light of the question or imply that I have the answer, and also asset pricing investigates all sorts of other phenomena. But our economy's capacity to bear risk dropped sharply. So here's the question. Is that because people wanted to bear risk, but financial or banking frictions prevented them from doing so? Or is it because they didn't want to in the first place? And if so, why? Well, that's a good question, and that's our question. I'm missing something here. I don't want to miss a joke. Yeah, there we go. Now, here's a friction. Trading-related liquidity does strike me as a friction that's potentially important for the big picture. I'm inspired by one of the most obvious liquidity premiums of all. Money is overpriced. It has a lower discount rate than government debt, though there are claims to the same payoff in a frictionless market. And that liquidity spread can be huge, hundreds of percent in hyperinflations. Well, of course, money is special. It's special for its use in transactions. But securities are special in trading, too, which needs a certain supply of physical shares. We can't support large volumes by recycling one outstanding share. So here's a suggestive picture. The stock price and fall of the late 1990s, which I've plotted on the left here, was concentrated in NASDAQ and NASDAQ Tech. The volume rise and fall on the right was concentrated in the same place. Every asset price bubble, defined here by people's use of the label after the fact, has coincided with a similar trading frenzy, from Dutch tulips in 1620 to Miami condos in 2006. Now, is this a coincidence? Do prices rise and fall for other reasons on the left, and the trading volume just follows with no effect on the price? Or is the price, equivalently a low discount rate, to some extent explained by the huge volume, by the values of shares in facilitating a trading frenzy? Well, maybe the question of how information is incorporated into asset markets and why it needs so much trading will come back to the center of inquiry in a few years. Now, discount rate variation will change a lot of practical applications as well, and we do practice, not just theory. A huge literature explores how investors should exploit time-varying expected returns. The problem is the average investor has to hold the market portfolio. We can't all market time. We can't all buy value. When we can't even all be smarter than average. We can't even all rebalance. So I think our discount rate facts and theories suggest a different portfolio theory that's consistent with the adding up theorem, built on differences between people. So think about Fama and French's story for value. Their story is that the average investor is worried that value stocks will fall at the same time the investor's human capital will fall. But if that's true, some investors, steel workers, they'll be more worried and they should short value despite the great value premium. And some others, tech nerds, they'll have human capital correlated with growth stocks and they should buy lots of value, effectively selling insurance. So what do we get? We get a three-fund theorem, a three-dimensional multi-factor efficient frontier, shown here in place of the mean variance frontier, and a three-dimensional headache for our average investor to figure out which of these funds they should go in, without even mentioning alpha. And of course now we have dozens of such systematic risks for each investor to consider. And there's the unpriced factors, which are probably more important. Our steelworker friend, before he starts thinking about value, should start by shorting a steel industry portfolio. We as academics should understand the variation across people in the risks they hold that are hedgeable by systematic factors, and we should find low-cost portfolios to span that variation. We haven't even looked. We've spent all our time looking for price factors that are only interesting for the mean variance investor, but he's got to be measure zero. Now, all of this sounds very hard, a 27-dimensional graph and 27-dimensional theorem. That's great. Hard is good. We finally have a reason for a fee-based, tailored portfolio industry to exist, rather than just deplore it as folly for another 30 years. We finally have a reason for us to charge fat tuitions to our MBA students and not just tell them the markets are efficient, they should go drive a cab. We finally have an interesting portfolio theory that isn't based on chasing zero-sum alpha. Now, discount rate variation also means that state variable hedging should matter. It's almost completely ignored in practice. Almost all hedge funds and active managers use mean variance optimizers, though their strategies are based on the idea that expected returns and variances vary over time. Well, maybe hedging state variables seems nebulous. So here's a story to convince you that it matters, and a picture. Suppose you're a highly risk-averse investor and you have a 10-year horizon. You're investing to cover a defined payment, your 8-year-old's tuition at the University of Chicago 10 years from now. Your optimal investment is obviously a 10-year zero-coupon TIP, index bond. And the picture here in blue tracks the path of your investment through time. But suppose now that bond prices plunge, volatility surges, there's a crisis highlighted in yellow. Should you sell to avoid future risk? Well, no, obviously, duh. You should just tear up the statement. Short-term volatility is irrelevant to you. Evaluating bonds with a one-period mean variance. Now that's all perfectly obvious, but now imagine yourself a stock market volatility on the right has risen dramatically from 16 to 70%. What do you do? Well, the standard formula says sell everything. Numbers that imply 60% of stocks in normal time say you should reduce your equity share down to 4%. But wait a minute. Not everyone can do this. The market didn't fall 93%. Is everyone else just being stupid? They don't know this formula? Was the market irrationally overvalued in the depths of the financial crisis? Well, no, of course. The answer is that one-period mean variance analysis is completely inappropriate. If the world were IID, volatility wouldn't have changed in the first place. Stocks are a bit like bonds. Price-dividend ratio declines raise expected returns. To some extent, short-run volatility doesn't matter for a long-run investor. State variable hedging matters a lot, even for this most simple of real-world applications. Or maybe not. Telling a bond investor to hold 10-year zeros because their price happens to go vary properly with state variables for the investment opportunity set just completely confuses what should be totally obvious. Maybe dynamic portfolio theory overall might get a lot simpler if we look at payoff streams and initial prices rather than looking at dynamic trading strategies that achieve those final streams. If you look at payoff streams, it's just perfectly obvious that an indexed perpetuity or an annuity is the right risk-free asset for a long-term investor, and that holds no matter what the time-varying return moments. Well, how about risky investments? That's our challenge. Here's a very simple and suggestive first step. If utility is quadratic, it turns out that you can still use two-period mean variance theory to think about the streams of payoffs. Every optimal payoff combines an indexed perpetuity, that now falls on the left, and a claim to the aggregate dividend stream, that's our new tangency portfolio. And state variables completely disappear from portfolio theory. This holds with arbitrary time-varying expected returns, the same way they did for our 10-year bond investor the minute he stopped looking at the one-month problem and started looking at the 10-year problem. If our stock market investor or endowment thought this way, he would have answered, I hold the aggregate dividend stream. Why should I buy or sell? I just tear up the statements. That's a lot simpler to explain, implement, and understand than calculating optimal hedge portfolios. Now, of course, quadratic utility is a troublesome approximation. Still, I glimpse here the possibility that a price and payoff approach can give you a much simpler two-dimensional view of portfolio theory rather than 27-dimensional version of my last slide, as well as a simpler version of pricing. Let's talk about performance evaluation. In the 1970s view of the world, there was one systematic risk, the market. Active management chases alpha, and that's uncovering inefficiently priced assets. Well, now we have dozens of dimensions of systematic risk. Many hedge fund strategies include an element of option writing. And to have a fun picture here, I show you the returns in red. These are the annual returns of the, quote, equity market neutral, unquote, hedge funds. Now you know why I put that in quotes. The blue line is the market return. You're looking at an option writing strategy. I once tried telling a hedge fund manager, you don't have alpha. I can replicate your returns with a value growth momentum carry and short vol strategy. He looked at me and said, wait a minute, exotic beta is my alpha. I understand those systematic factors. I know how to trade them. You don't, and my investors don't. Now he has a point. How many investors have ever thought through their exposures to carry trade or short vol systematic risks? How many of them are willing to consider those as passive mechanical investments like the Vanguard total market? There is no more alpha. There's 27 varieties of beta that I even ran off the screen on the bottom. There's beta you understand, and there's beta you don't understand. That's performance evaluation today. Finance is about a lot of procedures, too, very applied procedures. The first slide in a capital budgeting lecture looks something like the one I put down here, and a 6% market premium, all of which we now know is completely wrong. Now, how do we solve this problem? I don't think the answer lies in complex multi-factor betas and dynamic time-varying risk premia. This is a relative pricing exercise. You don't need deep explanation. So simply understanding the discount rates as a function of the characteristics, or better understanding the valuations as a function of characteristics, may end up being more fruitful. We don't have to explain discount rates, as we're trying to do here, in order to use them. Similarly, accounting, regulation, capital structure. Suppose a firm has a single cash flow in 10 years from now, and it's funded by a zero coupon bond and equity. Now, in most accounting, capital structure, and regulation, we would use those stock and bond prices to calculate the probability of default. And if the price goes down, we say, well, they're in more trouble. But suppose prices went down because discount rates rose. That fact has no implication for the probability of eventual default 10 years from now. There is such a thing as temporarily depressed markets. And maybe the more inertial procedures we see in practice do make some sense. Well, discount rates vary a lot more than we thought. The puzzles and anomalies we face amount to discount rate variation that we don't understand. Our theoretical controversies are all about how discount rates are formed. And we need to incorporate this discount rate variation in applied procedures because our empirical view of the world has changed 100%. We're really beginning all these tasks. These facts need at least a dramatic consolidation. The theories are all in their infancy. And most applications still implicitly assume constant expected returns and the capital asset pricing model. And as always, the real challenge is how to frame the question. These are issues best discussed over a beer. So in my last act as AFA president, let me thank you for listening and invite you to the reception after David closes the meeting. Thank you very much.